guest. We've got Mr. Scott Forehand here from the Forehand Agency. That's Forehand Financial Group, and I'm excited for this hour. I've talked to Scott plenty of times here on Ask the Expert over the years, and I'm glad to have this conversation with our weekday listeners. So glad to have you here, Scott.
You know, we used to, when we first started doing this, we would do a Thursday show, and it got to be a whole lot too much for us, so we had to pull back to one day a month. And I kind of miss this. You know, it was nice having a little drive in here this afternoon, going against the traffic, not with the you know. I wasn't stuck in traffic. Everybody was stuck, and I was like, look at me, I'm going 55, 60. It's pretty cool.
Yeah.
So yeah,
it's a good change of pace.
Yeah, and also I haven't done a show with you in a while, so it's nice to see you again. I hope you and your spouse are doing well, and I hope your farm's doing well, which I've always inspired to hear about, because that's a lot of work, and I was never a farmer, but I certainly eat enough eggs and stuff that farmers produce to be a connoisseur of good farming practices.
Well, I appreciate it, man. It's great to see you too, and I've been looking forward to this conversation since I saw it on our calendar.
Nice.
So I'm excited for it. I'm excited for everybody listening too to get to pick your brain a little bit to this hour.
Well, so we are going to be live. This is live, and people can call in if they want. I've got a special guest with us this week. I'm gonna try to do this on a fairly frequent basis. So we've got Mr. Rob Lee coming in from Jacksonville, Florida. He runs our Jacksonville office, and nice to see you, Rob. At least I see you remotely. Can you hear us good?
Yeah, I can hear you loud and clear.
All right.
Hope everything is well. Can y'all hear me okay?
Yeah, fantastic. I see your plane in the background. Rob's our resident pilot, so whenever we want to go somewhere, we just pick up the phone and say, "Hey, Rob, come pick us up. We want to go to Vegas." And of course, Rob says, "Sure, I'll be there. Provide me the plane." And then, so it's nice to have a pilot in the team. So hi, Rob, and as always, you know, we've got three parts to the show. We've got a part we're going to talk about the markets and the charts and what they say, and we're going to talk about some alternative strategies to leaving your money in a 401k and watching it go down with the ship as the ship is sinking right this minute. And then we're going to talk about some other alternative strategies that we call infinite banks or infinite banking concepts, or we also call them debt-free life programs or cash flow banks. There's a lot of different names for them, but they're all the same thing. It's just those programs are places where you can put your money where it will grow with a guaranteed interest rate and a dividend, where the IRS won't be able to see it, touch it, or tax it, and you can use it for retirement whenever you want, not when the IRS says you can retire. So that'll be the last segment. So let's jump right into it. The charts. Hey, Rob, you've been paying attention to the market. You see how much the market's moving recently?
I just spoke with someone a couple minutes ago before this that reminded me of what happened too.
Yeah. Well, here's the good news, folks. The good news is, unless you're really, really close to retirement, this is something that was kind of needed. The market, and I'm going to quote Jamie Dimon, the market was 26% overbought, and there needs to be a correction. Now, for those of us that have money in the market that are feeling this correction, we would probably disagree. However, where it's not sustainable. It doesn't make sense financially. The numbers that were out there, the numbers and the income that these companies were making did not support the pricing that their stocks were being issued at, and that was a pure, hyper enthusiastic general public sentiment to try to buy stock because it's going to go up. And I've heard people say, and every time I hear it, I cringe. It's going to go up, and it's going to go up forever. And no, it is not. Okay, but I do want to offer some folks that are having some negative effects right now a little bit of hope. This is a short-term thing, and these market oscillations, these happen. This happens every 4, maybe 8 years, and you have big market adjustments that happen every 8 to 12 years. And this is a market adjustment. Certainly, what Trump's doing with the tariffs and stuff like that is certainly having an effect, but this is kind of expected. And everything's kind of interconnected. the market, when you look at the market in general, it's not one thing. It's made up of a bunch of stuff. It's made up of companies that sell and produce energy. It's made up of companies that sell and produce permanent widgets. It's made up of companies that sell and produce food. So it's everything. The market as a whole is everything. And when we have a market correction like we have periodically, like is needed, then this is actually a good thing. This is nothing more really than some people taking money off. Now, the question to ask really, where's the money going? It's not just evaporating. And if you look at banking stocks, the big boys, the Wells Fargo and the PNC and Truist and those guys and Citi, they're not having banner years. Where's the money going? So the knee-jerk reaction this time last year, because the transition, the outflow of money last year, the common concept was that it was going into Bitcoin and other cryptocurrencies. And we see what's happening with Bitcoin and crypto right now. That's just a correction. It was overbought to begin with. So where's it going? And what I would say is that people are putting money into alternative assets that are on the sidelines waiting for the market to hit that bottom. And that kind of is a great segue into a review of some of the charts we're going to talk about real quick. So the first thing I want to look at is over history, we see trends that are created in various stock market moves. And Rob, if you're following it at home, I'm talking specifically, it looks like it's figure 3. And where we are right now, we have a general trend, which we're all feeling it, we're all seeing it, we're all watching it happen in real time. We have a general trend of a negative move in the market. But here's the thing. When you look at this chart, there's a couple of indicators that tell us the speed of the move and what the expected time the move is going to continue for. And in this particular chart that I'm looking at right now, what it's telling me is that the speed of the move that we're having over the course of the next 3 weeks, it's going to be relatively constant. It's not going to speed up too much. It's not going to slow down too much. And it's also telling me that it's going to move for a while. This doesn't tell me, yes, it's going to be exactly 12 days. It doesn't say that, but it does say I don't see a thinning of the difference between the two primary indicators. That when it thins, that means that the trend is getting close to an end. I see a trend that opened up and widened and is still as wide as it was when it widened 2 weeks ago. So that tells me that this trend is going to continue, which is, again, not a bad thing. There's some things people can do. We'll talk about that a little bit later to help mitigate some of that loss. But this is why when we talk about people that are at or near retirement, it's a real good idea to take some of that money off the table, to not have it at risk, because you'll hear a lot of financial advisors say this, and we all mean it. Sometimes it's better to have a return of your money than a return on your money. And if I can have money invested in a place where I can't have a loss, I won't have a loss, but if the market goes up, I'm going to capture most, or in some cases all of that gain, or actually in some cases more than that gain. I've seen some of these programs where the market went up 10%, but because of the way the index was structured, the index actually performed with 12% gain. So the point is that sometimes it's better to put money in a place where you can't lose, because it's more important to make sure the money stays there. Loss is so much stronger than the power of gain. If we do that quick math, if I lose 20% of my nest egg in the market, and the market gains 20% the next year, am I whole? And the answer is no, because I lost 20%. So say it's 100,000 dropped to 80, and then I made back 20%. 20% of 80 is not quite $20,000. So I'll be at less than where I was the previous year. So I didn't even make all my money back. So the power of loss is stronger than the power of gain, and that's something we have to be cognizant of when we get at or near retirement. Rob, feel free to jump in anytime, buddy. This is, I have you here because I want to get your insight on some of this stuff. What I'd like to look at now, if you're looking at the program at home, Rob, I'm going to look at the first page. It looks like it's going to be, it actually might be the second page, figure 8. And this is a cool one that I go over every time pretty much. This is the S&P technical composite. And there's some key trading occurrences that happen. And there's a thing called a yashiki, and there's a thing called a head and shoulders. And these are trading patterns that indicate a specific move is going to happen in the future. And this particular instance on this, what we're seeing a bounce. We saw the market go all the way down, hit a floor, what we thought was a floor, and then we saw an attempted recovery. That was yesterday, or actually it might have been Monday, where the market went up. It was up 600 or 700 points early, and then it ended up the day was down. Okay, so that is actually taken into account. And what happened is, and this is a technical term, it tested the midline. So the market bounced up. It hit that midline number from halfway between its lowest in the last 6 months and its highest in the last 6 months. It hit that middle number and then bounced down, and that tells us that the market is certainly not ready to continue to try to recover yet, which is good because there's no reason for it to recover. The United States as a whole didn't just all of a sudden overnight significantly increase the GDP. All these companies did not overnight just all of a sudden become so much more profitable than they were before. So that's the correction that we're looking for, is for the stock market prices to truly reflect the health and the profitability of the companies that are represented by those market prices. And it's coming, and it needs to. And that's a hard pill to swallow if you're at retirement, I understand. But there's some things, like I said, that you can do to help protect against that. And the last thing I want to look at is, Rob, if we're going back, we're going to the S&P index. And this is a 12-month consolidated index run. And what we're seeing is what these other two charts we just looked at, what we see is that it's confirming what we already know based on reading those other two charts. It's confirming that the market went down and hit a floor and then bounced back up, hit a midline, and now it's bouncing back down. So here's the thing. Is it going to create a new floor? That's the question. And here's where we are. We are at, right this minute, we're at that bottom line of where, in theory, the new floor was created. If it goes through it, then the next floor, it's going to lose another 10, 12, 15%. And that 10, 12, or 15% minus from where we are right this minute, that floor is established for years. So that's a much more stable floor than what we're trying to look at creating right now, which has only been established since August of last year. Okay? So that's kind of the technical analysis of what's going on. This is not anything that hasn't happened before. The different reasons where market corrections happen, it's different every time. The big correction that started the Great Depression back in the 20s, there was a different set of reasons that started that versus the one that happened in the 90s, versus the one that happened in the year 2000, versus the one that happened in 2008, versus the one that happened in 2022. So there's a correction. The corrections are needed. The quote unquote straw that broke the camel's back is different in each instance, and you never know which one is gonna affect it. So Rob, you got any comments on this stuff while I drink some coffee? I need more coffee.
Yeah. I actually just 30 minutes before this began was speaking with someone that called me and says, "Man, I just lost $80,000. What would have happened if we would have had that moved over to one of your plans?" And then I mentioned, some of the plans, of course, they have a floor that you're not going to fall beneath. So therefore, instead of losing that, and it's funny you mentioned about you lose 20%, people think if it goes up 20%, it takes them back where they were. And I had to explain that part to him too. You're playing with less money, so obviously it's not going to go back up to where you were. So putting a plan in place and even kind of spreading it around so you still have access to some liquid funds, if you will, but also just having something that's going to make money off your money is always the way I try to guide everyone.
Yeah. I'm going to put your client's situation in practice. Let's say we met with him 2 months ago and we had put him into one of our programs that are a bonus program. So where we would be right now, his money would be at 20% higher than it was 2 months ago. And when everything else lost like this, we're not doing anything but clapping, because as it rides down and it's resetting the floor, and when the gain starts happening again, we're going to capture all that gain and add it. So where his colleagues that rode it down and are going to ride it back up, they're going to be close to where they were when it all started. Where he's going to be is 20% higher than where he started, plus whatever the gain is between now and then. And that's the key here, folks. This is one of those things that we're talking specifically at this particular instance about what's called a private pension income annuity. Now, there's some annuities out there that have a bad rap. Those are what we call variable annuities. Those annuities you can, and unfortunately, in a lot of cases, will lose money. Okay, they're there for a purpose, though. It's usually not the money purpose. What we're talking about is a private pension income annuity. It's there for income. It's there for permanence. It's there so that you can't, Rob, what's the number one thing that people worry about with retirement? What's the number one thing?
Outliving their money.
It's about how do I have enough money to last me forever? And that's the cool thing about these private pension programs. We can set them up so that they will last forever. Okay? So if we're looking at those private pension annuities, it's a tool. It's a tool to help make your financial plan and your retirement plan perform forever at the way that you want it, however you want it. Now, let's be real. If your private pension starts with $100,000, you're not going to be able to pull $100,000 every year out of that. It's not going to happen. There's going to have to be some accumulation and some compounding that's going to go on over time. But, we can make, if you were going to pull, let's say, $25,000 out of that, if you didn't invest it in a private pension income annuity, that would last 4 years. And putting it into an annuity, maybe you take a little bit less. Maybe you take 18, maybe you take 19, but it becomes permanent. And that's the key here. It's about not outliving or making sure that you're not going to outlive your money, or better yet, make sure that with survivorship, that it's not going to be something that's going to affect you, just you. It's going to be there for you and your spouse, whoever that person may be. And then finally, with these programs, there are some other benefits. I know, Rob, you and I talked about a couple of them. That some of these private pension income annuities have some really, really cool benefits, especially when it comes to things like long-term care solutions, and again, back to survivorship and different ways that we can index the funds. We don't have to be in equities where we can lose. We're not going to be. We're going to be in indexes. Got any comments about that one, Rob?
No, it's so true, and I love being able to show everyone that, how we can take an illustration and let them kind of make the choice on how long they want to stretch this out. We all hope that we're going to live as long as Moses, so we definitely want to make sure we have things in place to be able to provide for that. And but without the crystal ball, reality is, just making sure that we have the plans to cover up until the time where we're no longer here, but then our family's able to have some benefit as well that can help them with some different items too.
So here's the good news, Rob. You and I and a bunch of our colleagues, we're licensed all over the country, so we can help anybody anywhere. And if you want to call the show's live, and Damien's going to give you that number in just a minute. And if you would like to call and set up a conversation or a consultation, which is free, with one of our advisors, that phone number is I can't remember the number. Do you remember the number?
Another website?
1264. You got the website? Yeah, let's give them the website. That's a good way to go. It's forehandagency.com. Oh, yeah, and that website, we've got a couple of them. That's the newest website. That one's actually got a calculator, an investment calculator on it, so go check it out. And you can plug in your information, plug in your investment, and for however many years you want it to run and what you're going to contribute on an annual basis, and it'll tell you how much it's going to be worth at a specific point in time. All right? And so our phone number should be 278-1264, area code 757. Or maybe it's 268-1264. We'll check on that when we get back.
Yeah, absolutely. We'll be back here. We do have open phone lines at 627-7979. 627-7979. That number, 757-278-1264. Or again, go online to theforehandagency.com. God, welcome back. Glad to have you here live in the studio.
Yeah, I just wanted to clarify one thing. This is the news station, not the snooze station.
No, of course not.
Yeah, right on. All right. So, yeah, awesome. Back here with Professor Lee, as we like to call him, or sometimes Dr. Lee. He's got a lot of nicknames within our organization. Anyway, when we stopped, we were talking about private pension income annuities, and we were talking about another alternative that just came out. It is not just came out. It's been around for a while, but it was typically only available for accredited investors with at least $200,000 of liquid capital to invest. And now those rules have changed, and now they're eligible for people with only $30,000 of liquid capital to invest. So you're going to get the same kind of performance. And here's the cool thing. The cool thing is that the performance is a tax-exempt performance, and it's permanent. And the average return is about 10% per year. Now, these programs are pretty convoluted, all legal, and they involve a number of different disciplines, not just planning and things that Rob and I do. But if you're one of those folks and you're looking for a program where you can guarantee that your money's going to last for a long time or forever, and you have at least $30,000, actually it's $60,000 total, $30,000 2 years in a row, to invest in a program, then we've got the right program for you. And that's one of the things that I just did a couple of these, 2 down in Florida and 1 up in Pennsylvania, and the people are giddy. And it was my first exposure to them, and I'm thinking about doing one myself. So it's pretty strong. All right, so now we're looking at private pension income annuities, and you've got a lot of things out there that they can do. It's not just income that they can do. They can provide death benefits, which is part of the game anyway. If you're trying to leave a legacy for your family, you can leave a legacy with cash, or you can leave a legacy with cash from a death benefit. Well, some of these programs do both. And then you've got other things like there's a long-term care analog. If you're in Virginia listening to this right now, Virginia is a Commonwealth state, and there's the way that Virginia treats long-term care is a little bit different than the way other states treat long-term care, and where Virginia will come and help you and step in if you end up needing long-term care support. They're not going to do it until you've divested yourself of all but about $2,000 of your assets. So the interesting thing about a private income annuity is the minute you annuitize an annuity, before you annuitize it, it's an asset. If you've got $300,000 in there, that's a $300,000 asset. And if you were going to use some of that for long-term care, they would make you liquidate it, and then they would make you liquidate all of it down to $2,000 before they'd step in and help you out. But because it's an annuity, you can flip the switch and create an income stream from it. And the income stream is not an asset. The asset is the cash value. And when you annuitize an annuity, the cash value goes to zero. And then it becomes just an income stream, and then you can qualify for your long-term care support. Now, here's the other cool thing. In the history, most of the time, those annuities, one of the reasons why they get a bad rap is because once you annuitize it, it's a permanent income stream. You can't do anything with it, right? Wrong. The new modern annuities, at least one that I know of, will actually allow you to unannuitize it, which is really cool. So, for example, I have a couple that I was working with that have a young daughter who's 16, and they were trying to get her qualified for college funding. And they had too much money. So they put it into an annuity, and then they annuitized it. So they still have their money. It's in an annuity, and it's no longer considered an asset. And now the child will qualify for funding. So these are little tricks. We're playing by the rules. We're not doing anything wrong. It's just that's the way the rules are written. We'll play by their rules and use their rules against them. And that's what I love about solutions like that and systems like that. Do you have any stories like that, Rob?
I've had, a couple different stories, similar, but where someone's had money, kind of just put it in a different annuity just to kind of keep it outside of from taxable, and able to do things like that. But in comparison with yours, that's definitely a really good way to use that.
Yep.
And like you say, there's certain rules that are put in place, and we follow along with those. We can get benefit from those, luckily.
Yep. So again, this is different ways to diversify someone's portfolio. For example, I had a gentleman I spoke with the other day who said, "Yeah, I'm really diversified." I said, "Yeah, how are you diversified?" He said, "Well, I've got $700,000 in my IRA, completely diversified." I said, "Okay, well, how is it diversified?" He said, "Well, it's in an IRA, so I've got a little bit of this and a little bit of that and a little bit of this." And I said, "So you've got $700,000 of your retirement plan in an IRA?" He said, "Yes." I said, "All right, so your diversification comes from what other funds you have elsewhere. So what do you have elsewhere?" "Nothing." So you are not diversified. In fact, you have all your eggs in one basket. That basket happens to be an IRA, and with the restrictions and the tax exposure associated with an IRA. And so when I'm speaking in terms of diversification, I mean there's a lot of financial tools out there. It's not just equity positions. It's not just money markets. It's not just bonds. It's not just CDs. It's all of it. And your money should be diversified. I asked this question, well, I've got my money in a bank and it's safe, right? Well, okay. We had this conversation last year, but have you ever heard of a bank that failed? So in the United States, on average, there's 40 to 60 banks that fail every year. And then when we look at these annuity programs and some of these other life insurance vehicles that we use, those are typically offered by life insurance companies. Can you name a life insurance company that's failed? And of course, after a long pause, there's no response because there isn't. You are very hard pressed to name even one life insurance company that's failed. And the reason why is because the restrictions associated with getting a charter to be able to offer life insurance are so strict with how much funding, how much capital, and how much reserves they have to have that they won't fail. They couldn't fail. The only time I can see a life insurance company failing is if all the people they insure is in one section of one county and that county gets blown up. That's the only way I can see that. And the likelihood of that happening is pretty slim. So that's what we look at. We look at places, putting money in places that are going to be safe, putting money in places where we're going to have some kind of guarantee of our return, and putting money in places where we do have some degree of control over it. When you move money into these IRAs, or from these IRAs into these other types of IRAs, individual retirement annuity IRA, same thing. Then we're going to take some control. We're just taking it out of what is, in general, a banking industry regulated program, traditional IRA, 401k, 403b, 457, KEOSEP First, TSP, all those, into a program that is contract law governed, because these programs are, an annuity is a contract. And so it's governed by contract law, not by banking law. So we'll be back in just a few minutes, and What are those numbers again, Damien? If they want to call our office.
Yeah. The Forehand Financial Group, that's forehandagency.com. Call 800-677-0989. That's 800-677-0989 or local 757-278-1264. That's 278-1264. Or you can always join us here for the last few minutes of the show, 627-7979, and we'll get you connected too.
Awesome.
But we are live. We'll be right back right after the quick break. It's News Talk 790 WNIS with Scott Forehand and Rob Lee right here on Ask the Expert. It's Mr. Scott Forehand with Forehand Financial Group. You can go to his website, theforehandagency.com, with special guest Rob Lee here for this show. So glad to have you guys back here for the show. Very informative.
Yeah,
Welcome
man.
back.
It's good to be here. I like I said, I love the drive in here, and I'm going to love that drive home. It's a nice ride. So looks like there's somebody waiting in the wings there. What do we got?
Right. We've got Alan in Buckrow Beach, Hampton. Welcome, Alan. How are you?
Hey, I love the show. I love the station. Hey, look, I'm like 65 years old. My mom passed away 2 years ago.
I'm so sorry.
I live with my dad now. He's 88, but he's doing well. But he has been telling me several things since my mom passed away that sometimes I don't quite understand them. And I just want to bring one up. By the way, I'm going to take your comments off the air, but it's about bonds. And he told me a while back several times, he said, Alan, when I'm gone, make sure you go to the bank with that key. He gave me a key to some lockbox thing, and he said that there's close to $300,000 in the bank that him and my mom had acquired through the years called bonds. And to be honest with you, I'm not sure what a bond is. And, I mean, do you cash a bond, or does a bond draw interest all these years that my mom and dad has had it in the bank? I mean, what's a bond, and what do you do with it? I mean, I just don't understand the whole bond thing, and I'll take your comments off the air.
Sure. All right, well, thanks for the call, Alan, over in Buckrow. Love Buckrow. It's gorgeous over there. So first thing, what are bonds? So bonds it's an investment instrument that are typically offered either by municipalities, government entities, or in some cases offered by corporations. So a bond is an instrument to raise money for the corporation. So someone purchases the bond, usually at some number. Let's say we're purchasing a $1,000 bond, and let's say it has a 10-year maturity. So they would purchase a $1,000 bond. They would only pay maybe $600, maybe $800, maybe $900 for it. And then in that 10th year, the bond is worth the full face value of $1,000. That's one way they work. Another way that they work is they're bought and they accrue a certain amount of interest every year, or sometimes every quarter, or in a few instances they can even accrue interest on a monthly basis. So bonds are instruments for places to raise capital. So, for example, locally, all this road construction that happened around here, Interstate 64 and the high-rise bridge in Chesapeake and the widening of Interstate 64 up to Williamsburg, all that was accomplished with grants from the federal government and bonds. There were bonds that were bought. So, and there's different classes of bonds. Sometimes you can redeem them early. Sometimes you have to wait. Sometimes they are automatically cashed in for you at certain points. But bonds are a very safe form of investing, and it's something that when you look at where there's a mass exodus from the stock market and the money's not going into banks, where's it going? It's maybe going into crypto or bonds. That's where people tend to spend money when the return on equity investments is lacking. So those are the two. I think that's two of the questions that you asked about the bonds. And one thing you said that was interesting to me was you said your father had a key and gave you a key. Now that tells me that there's a paper document in that safe deposit box, which means it could be another kind of bond, which is called a bearer bond. And those are more rare, but those are super valuable because a bearer bond doesn't have anybody's name on it. And you can cash it in at the company that issued it as long as that company's still around. And there's an interesting story about this. There was a family that lived in Norview about 8 years ago that they got a call out of the blue because their grandfather had passed, and they were cleaning out the attic, and they found some silver coins, some gold coins, and a stack of bonds. And one of those bonds was actually a stock certificate from International Typewriter, which is what became IBM. And that particular family was, once they found out who they were, IBM sent them a private plane, sent them a limo, picked them up, took them to the corporate headquarters, and said, congratulations, that one stock certificate that you had has split 240 times since it was issued, and you are now the largest shareholder of IBM stock in the world. So there can be a significant amount of value in those things. Sometimes what people call a bond can actually be a stock certificate. So the doing that research and finding out what it is, it's going to take a little bit of time, but it's definitely worth doing. I had a client of mine that handed me a stack of bonds that he had no idea what they were worth, and it was kind of like a treasure hunt, and we went through it, and it took about 6 months to get the resolution for everything, and finally, in the end, we only found one thing that was worth any money. It happened to be a bond for development for a piece of land that was never developed. And it ended up turning into part ownership in a piece of land up in New Jersey that was on a private island. So it's kind of cool. So, yeah, so bonds. Bonds are fun. They're a good safe haven investment. It should be part of people's portfolio. It should not be the portfolio, but it should be part of it. And it's just another place where you can put money to diversify against, if the market tanks and you're in bonds, you're good to go. So that's the bond question. Hopefully I got that for you, Alan. And if not, you can reach out to my office, and we can help you kind of weed through that and see what you got going on over there. All right. So now the last segment, we're going to talk about a couple of things. We're going to talk about infinite banking, infinite bank strategies, what they are, how they work. We're going to try to get through this in 5 minutes. Mr. Lee, you want to start us off with this one? What's an infinite bank?
Infinite bank is a bank that you can use your life insurance policy to get out of debt, to use for other fundings. I like to set up participating whole life policies for people to have. So if they're in a great deal of debt, we can get them out of debt a lot quicker. Kind of use that policy to be able to take those funds and reallocate them. So if they're spending overpayments, and that's one of the main things we can take and capitalize on, and take that to use to do either snowball effect or avalanche effect. Once we put it into our program, we're able to determine the absolute best way and fastest way for them to get out of debt. And to be able to use infinite banking is creating your own bank. So You're not just paying another bank to be able to accumulate all the funds. You keep that for yourself and use it for a multitude of different things.
Let's role play a little illustration for the folks at home. If you're driving, don't close your eyes. All right. So Rob, let's say you have a car and you owe $5,000 on that car, and you have $5,000 sitting in your checking account, but you also have an infinite bank. What should you do with the $5,000?
I would place it into the policy to be able to accumulate from there,
the
and
infinite
then just
bank.
continue to make the payments to go out. So
Right.
to make until you're at a spot where you want to go ahead and use part of that to
Right.
pay it out, so you can evade a lot of that interest.
So if you did that, if you put that $5,000 into your infinite bank and then use that as collateral for a loan, and then put the $5,000 back in your checking account, it's not your $5,000, right? It's the infinite bank's $5,000. It's the company that offers the infinite bank. It's the contract holder. Your money is still with the contract holder earning interest in a dividend, right?
Correct.
And now you have $5,000 in your checking account, right?
Yep.
And now you can send a $5,000 check to your car company and pay the car off, right?
Correct.
So in this scenario, what did you just do? Whose money did you use to buy that car?
Well, you basically used others.
The carrier's money, yeah.
Yeah.
My money, in this case, your money is still in your infinite bank earning interest and a dividend every day for the rest of your life. Not to mention earning the death benefit and interest are growing even if you're not contributing to the program. And then the car is still paid off, right? Mm-hmm. Okay. So you just received $5,000 in equity in the vehicle, and you still have your $5,000 cash sitting in your Infinite Bank. Your net wealth just increased $5,000. And then, so that's how an Infinite Bank works, folks. If I've got $5,000 in my checking account and I send that $5,000 to that car company, the creditor, and pay the car off, all I did was transfer $5,000 of my wealth into that car company's wealth. And then in exchange, I received $5,000 of equity in what is most likely a depreciating asset. I did not help myself financially. If I simply put that money into my Infinite Bank first, make it work for me forever, guaranteed interest rate plus a loan against it, and then go pay the car company off, then I'm way ahead. Now I've got the company. I've got the company. They lent me the money. I paid off the car. I've got 100% equity in the car, and I've got that $5,000 working for me. But here's the pushback that people usually give me when they hear this. But I still have a loan, right? Well, yeah, you do. Your loan is secured by a vastly larger life insurance policy. So do you have to pay the loan back? Yes. When will you pay the loan back? I don't know. Maybe you pay it back because you're making payments. Maybe you let the guaranteed interest in the dividend pay it back for you. Or maybe something happens and the big man upstairs gives you the call, and that massive death benefit pays your loan off and then provides the legacy for your family that you've been trying to do all along. That's an Infinite Bank, folks. They are brilliant. This is not me. This is not Rob. We didn't come up with this. There's a guy by the name of John D. Rockefeller that came up with this. This is his system. This is called the Rockefeller Method. And it works. And it has worked for wealthy families since 1904. Not new. What do you think about that, Damien?
That's pretty nifty. Pretty cool.
Yep. Damien's got 3 of these Infinite Banks running already.
I know, right? Well, you're not supposed to tell people about it.
I know. We just want people to know that Damien is now independently wealthy because he's got Infinite Banks.
Tell people that people are going to come coming for money, all sorts of problems. I'm not ready for that.
Yeah, so the answer, your response should be, yeah, I'm happy to help you. Let's help yourself first. Let's go get an Infinite Bank with Forehand or Rob.
Yeah.
Right?
Yeah.
Rob, you got any comments on this one?
No, I mean, there's many other people that have had to use their policy also, so I don't want to drop all those out. There's a whole lot of them, but
yeah, there's tons of ways.
Wealthy people have used it for years.
Forever. Yep. Well, Mr. Damien,
with that, we're about out of time, gentlemen.
We are. One thing, normally there's a class that I teach. It's usually the Thursday following this event. However, it will not be next week because next week I'll be on vacation in the Dominican Republic. So no class next week. We'll be back with the class first Thursday in May.
You got it. Well, we'll see you then. I appreciate it, boss. Thank you so much. TheForehandAgency.com. TheForehandAgency.com. You're listening to News Talk 790 WNIS Norfolk.